Hello and good morning, everyone. My name is Jillian Bender-Cormier. I'm brand manager with Bender Insurance Solutions. We want to welcome you to another educational BenderU webinar discussing the credits and checks that are coming to employers with employee benefits. Some housekeeping notes. At the end of this webinar, we will have an engaging Q&A session that I will be facilitating. If you have any questions during the webinar, please feel free to type them into the chat box or in the Q&A section. During the Q&A time near the end of the presentation, I will be sharing your questions with our speaker. We want to be conscious of time, so if we don't get to answer all of your questions, we will gladly reach out to you individually after the webinar. You are all in listen-only mode and will remain muted throughout the webinar. This session is being recorded, and at the conclusion of the webinar, the recording link will be forwarded to you. We have a fantastic expert sharing with us this morning, Bender's own VP of Benefits, Chris Bender. Chris oversees the Benefit Insurance Department, which includes programs for employers in the areas of health, dental, vision, life, disability, accident, gap, critical illness, and more. He has served on the board of the Sacramento Association of Health Underwriters as the legislative chair, and is still active in the association. His efforts in meeting each company's objectives while focusing on regulatory compliance bring significant value to employers. Without further ado, welcome Chris.
Thank you, Jillian. Appreciate it. And thank you everyone for taking the time. I know these are busy times and very different, kind of strange times, to say the least. So thank you for taking the time to do so. So this is going to be a succinct webinar, and we're really going to try to compact everything in a 30-minute window. And so that means there's going to be a limited amount of material we'll go over, but hopefully by the time we conclude, you'll feel pretty clear about what your responsibility is with any credits or checks that you have coming. And some of you probably have already received credits. I know I've had a number of folks reach out to me already. So let's go ahead and jump right in. Okay, so what credits are we even talking about on the non-medical side? Because those are the ones that seem to be coming the fastest. Let's talk about what we're talking about. So we're talking about primarily dental and vision plans. Or in some circumstances, there's plans outside of dental and vision where some credits are being applied, but that's where we see the biggest amount of credits being applied presently is on group dental and vision plans. And they're coming in a number of different ways. Some are crediting like an entire month of the premium plan, and then some are providing a certain percentage, usually somewhere between 10 and 50% off of a particular month or a range of months. And then in some cases, there's a choice of either a credit or a rate lock, meaning you can lock in your rates for a period of time. And then in other cases, there isn't an option for credit, but employers are being provided with rate locks for a period of time. And that essentially means when your plan comes up for renewal, that you're able to maintain the same rates for a duration of a period of time. Okay, so let's talk about the medical side. What's coming on the medical side? So with health insurance companies, there are some pretty strict guidelines on, or I shouldn't even say guidelines, they're legal responsibilities that insurance companies have. Whether it's individual health plans or group health insurance, they have very specific rules they have to follow. Those are really all pointing to what is known as medical loss ratio. So the Affordable Care Act, when it was introduced with all of the legislation that went with it, one of those pieces was known as medical loss ratios. And that essentially means that over a period of a 3-year rolling average, these insurance companies are being looked at to see how are they spending the claims and what percentage of dollars that they collect for premium are being put towards claims. And that's really important because in small group, 80 cents of every dollar must be used for claims. And that's, when I speak of small group, that's going to be 100 or less full-time employees. That's going to be considered small group in California and many other states, though not all states. For large group, which is going to be, of course, 101 or more full-time equivalent employees, 85 cents of every premium dollar must be used for claims. So the question is, what happens if they don't spend 85 cents or if they don't spend 80 cents? What's going to happen there? So if you're a small group insurance company, let's say you finish out the 3-year period and it's calculated out that you've spent 76 cents for every premium dollar. That means you owe 4 cents to the group policyholders. And some of you that are on the phone, I know many of you have received some of these rebates. Usually they're pretty small, but something to be aware of, as you've probably seen those that are hooked up to the Business Journal or other means of getting their news. You've probably seen there's been some pretty significant losses. Those claims dollars that are, if the claims are way down, then whatever that delta is, that's going to be owed. And although it's a 3-year rolling average, 2020 presently is really, really low on claims, which in depending upon the healthcare organization, there's several that we have locally that are getting impacted severely. Probably saw some news around Adventist Health, Kaiser, Sutter, in the Northern California region that are just getting really, really hit hard. Now, with regards to the credits, when those come through, or those rebates, they are required to go out within 9 months of the close of the calendar year. So in the case of 2019 and the 2 years that are included before that, those checks are getting issued before the end of September. And there's very few rebates getting kicked out for the 2019 close, but I can tell you right now, unless something changes drastically, it's going to be some significant rebates. And we'll talk about what some of the insurance companies are doing about that even now. So who's providing the credits and rebates basically now? So first of all, the list is changing on a regular basis. And so what I'm telling you now could change by tomorrow. And you may have even heard an update that I haven't even heard yet. I get emails all the time and things are changing. But presently, there are, for example, there's a few carriers that are not kicking out rebates, but they're locking rates for a period of time. Some are locking them for an additional 12 months, some are locking them for 24 months, and Emeritus, Reliance, Standard, and VSP are a few of those that are locking rates, but not intending to do credits at this time, but that could, of course, change. Anthem Blue Cross is providing 50% off of April's fully insured dental rates and somewhere between 10 and 15% off of the fully insured medical for the month of April. Now, you might be thinking, well, April's come and gone. I don't remember seeing that credit. This decision came within the past month, and it's supposed to show up on your August invoice, which you should be getting before very long. So just heads up on that. United Healthcare is providing 5 to 20% credits to the June invoices. So some of you have probably already seen this for the fully insured benefits. And then Guardian is given the option of either a 1-month credit on dental or vision, or the option of a 24-month rate lock. Again, just holding the rates for your renewal for another period of time. And then MetLife is providing 25% off both April and May invoices, not including their dental HMO or their self-funded plans. And Principal Financial is providing 10% off of the June to October invoices on dental, and is including rate locks on several other areas of coverage, including areas like vision and disability and life. And so be aware that that's out there, and that's for their employers that have less than 500 employees, and it does not include the self-funded plans. Sun Life is providing 50% off the July invoice, probably already seeing that now for those of you that have your coverage through Sun Life, and it's not including the self-funding plan. I do want to mention, just because you've seen me say that a few times, or you've heard me say that a few times, that the self-funded plans are not part of this. The reason is self-funded plans only pay out claims as they occur. And so when claims are down, and with our self-funded clients, I can tell you the claims have been down, and not just a little, but a lot. So those self-funding folks are getting the option to be able to take, or I shouldn't say the option, but they're getting the credits right then and there, because when people are not accessing services, they're not paying claims. Okay, so continuing along the lines of who's providing credits and rebates, when we're talking about the medical claims, it's very likely, I've got to believe, as I've mentioned before, that unless there's just a massive surge in this pandemic, and I certainly hope there isn't, but if there is not, then by the time we get to close out 2020, they're going to be so far down. Some health providers are reporting below 50% of revenue. That's a massive deal. And so that there's going to be some rebates that are going to be kicked out. Again, remember though, it's based on a 3-year rolling period, not just 1 year. So with response to that, for example, Anthem is providing 10 to 15% off the April invoice, again, going to be crediting towards or showing on the August invoice, but it's based on the April invoice data. This will be credited towards their medical loss ratio, so I do want to make sure that there's clarity on that. United Healthcare, as I mentioned already, is also providing 5 to 20% off of the June invoice. That will be credited as well for their invoice. This won't include self-funded plans. We did talk about the reasons why, and because claims are not occurring, and so you're getting credited already. That's taking place. Again, they're usually issued between those rebates, May and October. So anybody that's getting them for the 2019 year should be getting them a little later this summer. The most common time to get them is around July and August. But just be aware, that's what we're talking about. As far as the 2020 year, you're looking between May and October of 2021. So how do you apply credit or rebate when you get it? And that's going to be important, because when you talk about the Section 125 rules, and just about everybody that is offering group health, dental, vision, those types of plans are providing those on a pre-tax basis, both on the contribution for the employer side and on the contribution for the employee side. And so because of that, there's strict rules on how you handle any types of credits or rebates. Here's the simple truth, and there are some employers, I know there's a number of employers that we work with, certainly they are the minority, but there's still several of them that offer contributions that are paying for 100% of both employee and dependents. In that case, super simple. Employer keeps everything because the employer paid for everything in that case. But the majority have a responsibility for the employer, or excuse me, the employees, to pay for a portion of their premium. And it may be the premium for the employee only, or it may just be that they're charging for dependents. And either way, those are going to be required to go back to the employees in some manner. Here's a couple different ways you can do it. If you want to avoid having to pay payroll taxes, this is the way you want to do it. You want to reduce deductions. You don't want to kick out checks. You want to reduce deductions so that if there's a particular group of employees that is owed a credit and they have a certain standard deduction that's taken, you can reduce the deduction according to the credit. And that will avoid you having to pay payroll taxes, and it avoids them being hit with more taxable payroll. The other way is providing a check or direct deposit to your employees, and that, as I mentioned, is taxable income. So that's important to remember that. And it's not so difficult to compute this type of information when you've got a composite rated plan, which means all employees have the same rate. All a spouse, employee plus spouse, employee plus children, employee plus family, those are all the same rates, and it makes it really, really simple. And for a lot of our large group customers, that's exactly what they deal with. For those of you that are in small group, it's much more complicated when you're dealing with a small group medical type plan where the rates are all over the board and everybody's got a different level of contribution. So we'll talk about that. Now, I do want to mention this real quick, and that is that you have the option when you receive a credit or a rebate to apply it to existing employees, or you can apply it to the employees or former employees that were applicable during that time period. If you do decide, let's say it was based on a rebate year of 2019, you could look at everybody that was affected in 2019 and go based off of that information. If you do, you need to make sure you're including anybody that was participating on COBRA. And of course, COBRA, there's the California COBRA, there's the federal COBRA. Federal COBRA, the loads that they put on the rates, you don't include that in the calculations, just the gross rates, not any 2% or 10% based on the federal or Cal COBRA charges that are administrative charges that go on. You don't include those. So let's look at an example of a composite rate and what does this look like. Let's say you receive a credit in the amount of $1,909.54 on your dental plan. And this employer pays 100% of the employee premium, but they don't pay any dependent premium. So you've got 41 employees participating on the dental plan for the month where the credit is applicable. And as far as breaking down that enrollment, it's going to be broken down with 24 employees as employee only, and their rate is $57.35. So that translates to the total there in the parenthetical phrase. And then we've got 9 that are doing employee plus family, 5 that are employee plus spouse, and 3 that are employee plus children. And you can see all of those specific numbers that when you take the 3 employees and multiply them by the 128 or the 5 employees by the 114, you're getting those totals there on the right. And then the invoice for that entire month was $3,819.08. So what you're receiving, of course, is a 50% credit in this particular example. So what happens? The employer was contributing during that particular month in question 100% of the employee-only rate. And so that means all 41 employees that were enrolled on that particular plan, the employer was paying $57.35 for that particular month. Now, that translates to just over 61%, which means that the employer retains $1,175.70. So that leaves the balance to be applicable for those folks that are paying dependent premiums. So here we are. We've got 38.43% remaining. So super simple with those 24 employee only, nothing's going to happen there. Those employees are not going to receive a dime because you picked up all of the costs for them. Those 9 employees, they had a rate of 164. So how does that break down for them? Well, out of that $1,484.73, based on the contribution, the dependents ended up paying the $1,484.73 minus that contribution. So that employee contribution by the employer leaves $968.58 left that was picked up by the employees for their dependent costs. That's 25.36% of the total invoice. That leaves $53.80. So you've got $484.26 total divided by 9 employees. That's $53.80 that's paid either via deposit check or a decreased deduction for those employees. And you could choose that decreased deduction how you see fit. I wouldn't make it too long of a period of time because that can get a little bit complicated. Probably I'll make it all happen in a month or two, and you'll be good to go. On the 5 employees with the rate of $114.70, once you take out that employer contribution of the $286.75, that leaves $286.75 left because the spouse coverage was just as expensive as the employee coverage, and that represents 7.51% of the total invoice. So 7.51% is $143 of the credit. So again, we keep pointing back to that overall credit, the same way we took the 25.36% from the credit, and that breaks it down to $143.41 divided by the 5 that are enrolled in that plan. So it breaks it down to $28.68 owed to each via the decreased deduction. And I'll go through the examples on the children as well, or the employee plus children, but the moral of the story is, look at the total contribution. What percentage of the invoice does that represent with that group of employees? And then apply that to the total credit. And that's how you're going to get the number. So here on the employee plus children, once you take out the employer contribution of 172, you've got 212 and change, which is 5.56% of the total invoice. 5.56% of the credit is $106.17. The 3 people that were on employee plus children are now owed $35.09. Again, can be paid via deposit, check, or can be a deduction, decreased deduction from any premium payments that they pay in the future. And if it's a decreased deduction, remember, that's not taxable. If it's a check or direct deposit, that is taxable. One more example, and we will be through and take any questions that you have. This example is on those of you that have a age-banded plan that you're dealing with a credit on, because that becomes a little more complicated. So in this example, let's say you receive a credit in the amount of $26,537.04. Of that whole year that is in question, and we're talking about a rebate, you had 84 employees in the plan, and you paid for 70% of the employee in the dependent premium. So how does that break down? Well, the nice thing is that the whole premium, you picked up 70%. So that remains constant. Whether or not it was employee dependent didn't matter. You paid 70%. So in this particular example, then the $616,000 is the total and change, of course, out of the 880, which is the gross premium that was paid during that particular rebate year. So we're obviously not going to go through 84 employees, but I want to use a few different examples to show you what you're dealing with here. So let's say employee 1 you're looking at, and again, this can be employees that are currently enrolled, or you can go back and look at the rebate year in question. You can choose either way to do the rebates. Employee number 1 paid $4,590 for that year. That represents 0.0052%, which is the rebate of a total of $137.99 when we look at this factor being multiplied against the total credit. In the example of employee number 32, they paid $23.50 That represents 0.0027% as the factor that is multiplied here. They're credited $71.65. And then final example is employee number 68, and that factor based on paying $9,447 represents just a little over 1%, because when you're looking at these types of factors, of course, 99 here would be 99%, 01 would be 1%, 0.0027 is about 0.25%, and this is about 0.5% once you take into consideration the way factors are managed. So that's $286.60 that is credited, and all of it points to what is the total they contributed and how much as a percentage does that reflect of the total premium in question. So that gives you a breakdown of what that looks like. I know that was really quick, and we've got about 5 minutes left for questions, so I'm going to go ahead and move it forward to the Q&A, and I will check with Jillian to see what questions we might have for these last 5 minutes.
Thank you, Chris. Looks like we do have a question here. Give me a minute. Okay. The question is, so the credits employers receive will apply to employee premium?
Yes, so the credits that are received is going to go against the gross premium, which of course is going to be the premiums that are paid by both employees and employers. Depending upon how that contribution is set up for that particular employer is going to depend on how much is paid by the employer and the employee, but the credits are being applied to that gross bill that is being received. So if you got a bill of $5,000 and it's a 50% credit for 1 month, then you've got a $2,500 credit. If it's a 10% credit, then it's the number shrinks to 10%. But yes, it will apply to the premiums of everybody that is enrolled in the plan for the period of time that is in question.
Perfect. Thank you for that. We also have just one other question, and it's a question that I can answer. It's whether or not the slideshow can be emailed after the presentation. And if you are interested in receiving a copy of the presentation, we'd be happy to provide that. So Kathy Nguyen, who asked this, absolutely, I can send this to you. Anybody else that is interested, please let me know, and I can forward it to you as well. Okay, Chris, we have another question. Since the medical loss ratios have been around for several years, why hasn't my company received a rebate in the past?
Yeah, good question. So it is always contingent upon whether or not your insurance company has fallen below that medical loss ratio threshold. So I'll give an example. Kaiser, who, when we're talking about California employees, they represent a huge chunk of California employees. Kaiser, as of yet, has not hit below the threshold where they've been required to send out rebates to employers. So them as well as Western Health, and there are some other carriers that haven't met, but if you've been enrolled with a particular carrier that does not have a time or a year or period of time where they've been below that threshold, then you won't receive a check. I'm fairly confident, unless something changes significantly on this pandemic, that Kaiser is going to have their first year of kicking out rebates about this time next year, just for those that are on the call.
Perfect. Thank you. We have probably time for just a few more. I know you mentioned that the best chance for rebates from insurance are after the close of 2020. Is Kaiser rebating this year for the 2019 medical loss ratios?
So yeah, no, Kaiser still not yet. They have not had a year, although if you saw the Business Journal news just a month or so ago, they were down significantly, and I have a lot of friends that work with Kaiser, and it is like a ghost town around there. So they're getting hammered, and chances are that 2020, unless something changes drastically, you're going to see some checks around summertime of 2021.
Perfect. Thank you. And I'll just squeeze in one more question. We are considering self-funding. Why aren't the rebates or credits coming on the self-funded plans?
Yeah, so one of the things I mentioned during the presentation is for those folks that have self-funding, the way that it works is you're paying claims as they occur. So in a self-funding scenario, if your employees are not going to access care, then you're not having to pay out claims. And when you're not having to pay out claims, you're getting what would be seen as a credit, even though it's not really, you don't really post it as a credit, you just post it as a really good month of not having to pay out claims. So the reason all these insurance companies say doesn't include self-funding or only for our fully insured plans is because the folks that are self-funded are, whether they be in a captive or level funded or traditional self-funded plan, are already seeing the benefit during that time.
Perfect. Well, it doesn't look like we have any other questions coming in, but thank you, Chris, so much for sharing with us today. We appreciate you all for taking the time out of your busy schedules to join us for today's BenderU on credits and checks that are coming to employers with employee benefits. Now, just as a reminder, this session has been recorded, and a link to view and share the recording will be emailed to you following the webinar. If you do suddenly have a question that pops up that or arises after the webinar has concluded, please feel free to reach out to us. We'll be happy to help you. But for now, thank you again for joining us for another BenderU webinar, and we hope you all have a wonderful day.